Hey, Mad Money fans, check the bottom of your screen for an exclusive offer. Next.
Tonight, we're talking sell-offs. Specifically during this block, what causes garden variety pullbacks. Many times the problem is indeed the Fed, as I mentioned before the break, but sometimes there are other issues that are driving the carnage. For starters, there's the issue of margin. As a former hedge fund guy, I'm well aware that there are many times when money managers borrow more cash than they should. So when the stock market goes down, they don't have the capital to meet the margin clerk's demands. These kinds of margin-induced declines have repeatedly happened, including, say, February of 2018. That was a good one, when funds that had borrowed money to bet against stock market volatility, the so-called VIX, got their heads handed to them. They were short the VIX, betting the market would remain calm, stupid, and at the same time, they bought the S&P 500 using borrowed money. Again, real stupid. When the stock market fell, these managers were forced to dump their S&P 500 positions. They had to raise capital and unwind their trades. There were so many managers doing this at once that their selling ended up causing some severe market-wide losses. Sell. These margin-induced breakdowns often occur after the market's down for several days in a row. That's why I'm often reluctant to tell you to be aggressive in the first few days of a big decline, because there will always be margin clerks against these managers, who buy stock with borrowed money, and it doesn't happen immediately. They have to keep chopping. How do you spot these margin call-driven declines? You know what? I use the clock. Margin clerks don't want their firms to be on the hook for overstretched individuals, or for hedge funds. They want to get out before the night. So margin clerks demand the collateral be put up, raise some cash, or they sell you out of your positions without your say-so. I always consider the margin clerk the butcher, and the butchering occurs between 1 and 2 o'clock. If the selling runs its course by 2:45 p.m., yes, I find it's actually that specific, then I think you have a decent chance to start buying safety stocks, the kinds of stocks that tend not to need the economy to be strong, to advance, like the health cares. You might also want to buy the secular growth plays that work in any environment, mega cap stocks. I talk about them all the time, especially to members of the CNBC Investing Club, because we like to own the best ones for the Charitable Trust. What else can create viable opportunities? Sell-offs from overseas. I cannot tell you how often I've heard commentators who scare the bejesus out of us because of imported worries, say, from Greece or Cyprus, Turkey, Venezuela, Mexico, countless other places. I always tell you to ask yourself, do any of these woes truly impact the stocks of the American companies in your portfolio? Do they really make you want to pay dramatically less for an individual U.S. stock? Usually the answer is no. Unfortunately, though, you can't just start buying stocks hand over fist into an overseas-driven sell-off. You should always assume there are people who don't understand how unimportant these worries are in the vast scheme of things. And, of course, those people are going to panic and sell after you would have thought they would have known better. That's why these international declines often last for 3 days. Again, the best way to figure out if they're done is to watch the clock, as the sellers usually need to be margined out against their will if there's going to be a bottom.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.